The Federal Reserve is trapped in a policy corner that nobody in mainstream financial media is discussing. If they raise interest rates now, they don't crash silver prices like conventional wisdom suggests. They trigger a supply collapse that sends silver soaring toward $200 per ounce. I've spent weeks analyzing the Fed's impossible position and discovered something that contradicts everything Wall Street believes about precious metals and interest rates. The relationship has inverted completely, and most investors have absolutely no idea what's coming. Here's why this matters right now. Conventional financial theory says higher interest rates hurt precious metals. Gold and silver don't pay dividends. When rates rise, investors supposedly move into yield-bearing assets. But that theory assumes normal market conditions. We're not in normal conditions anymore. The Federal Reserve faces a situation where raising rates doesn't suppress silver. It destroys the mining supply chain that keeps silver available at current prices. When mining economics collapse, supply disappears. When supply disappears, prices don't fall, they explode. The Fed understands this problem. That's why their recent communications have become increasingly contradictory. They're trapped between the inflation they must fight and a silver supply crisis they cannot acknowledge. Before I reveal exactly how the Fed's rate decisions trigger this $200 price spike, I need to ask something from you. If you're serious about understanding the monetary policy implications that mainstream analysts completely miss, then this channel was built specifically for you. Take 2 seconds and hit that subscribe button. The policy developments reshaping precious metals markets are waiting for investors who are relying on outdated financial theories. Drop a comment below and tell me where you're watching from. I personally read every single comment. I want to know who is paying attention to what the Fed does and want you to understand. Now, let's decode the Fed's silver problem. To understand why rate hikes trigger higher silver prices, you need to understand modern silver mining economics. Silver mining is extraordinarily capital-intensive. Companies borrow billions of dollars to develop mines, purchase equipment, and maintain operations. This debt is typically meaning interest costs rise directly with Fed policy. Here's where the mathematics become critical. The average silver mining company operates on margins between 15 and 25%. When interest expenses increase by just 2 to 3%, those margins get cut in half or disappear entirely. Mines that were profitable become unprofitable overnight. Really, let that sink in. A single Fed rate hike can push dozens of silver mining operations from profitable to uneconomic. When mines become uneconomic, they don't continue producing at a loss. They shut down. They suspend operations. They stop bringing silver to market. Approximately 70% of global silver production comes as a byproduct from other mining operations, primarily copper, zinc, and lead. These base metal mines face the same interest rate pressure. When they reduce operations, silver byproduct production falls proportionally. The Fed's rate policy doesn't just affect silver miners directly. It cascades through the entire base metals mining industry, reducing silver supply from sources that most investors don't even recognize as silver production. This is the silver problem the Fed cannot publicly discuss. Their primary inflation-fighting tool has become a supply destruction mechanism for a critical industrial metal. The $200 price target isn't arbitrary speculation. It's derived from supply-demand modeling that accounts for rate-induced production declines. Current silver production barely meets industrial demand even before investment demand is considered. Solar panels, electronics, electric vehicles, and medical devices consume over 60% of annual silver production. This industrial demand is price inelastic. Manufacturers need silver regardless of the cost because no substitutes exist for most applications. When rate hikes remove 15 to 20% of mining supply through operational shutdowns, the market faces a structural deficit that current prices cannot resolve. Here's the calculation that leads to $200 at $30 silver. Marginal mining operations require approximately 18% profit margins to service their debt and maintain operations. When rates rise and margins compress, these operations cease. At $50 silver, some marginal operations become viable again, but development timelines mean new supply takes years to materialize. At $100 silver, significant new investment becomes attractive, but permitting, construction, and commissioning require 3 to 7 years minimum. At $200, the market finally reaches an equilibrium where enough high-cost production becomes viable to meet industrial demand while servicing debt at elevated interest rates. The gap between current prices and $200 represents the supply destruction that Fed rate policy accelerates. The market must price silver high enough to keep marginal producers operating despite higher borrowing costs. This isn't speculation about investor sentiment. This is mining economics mathematics that most financial analysts have never even examined. So how should silver investors position for this fidendous supply crisis? First, recognize that conventional precious metals analysis no longer applies. Old correlations between rates and silver prices assumed functioning supply chains and healthy mining economics. Those assumptions are now broken. Second, understand that physical silver becomes increasingly valuable as supply tightens. Mining shutdowns don't affect existing above-ground silver. They affect future production. Investors holding physical metal-owned assets that become scarcer as Fed policy destroys new supply. Third, mining company selection becomes critical. Debt-free miners with low production costs survive rate hikes and capture extraordinary profits when silver prices rise. Heavily indebted miners with marginal operations face bankruptcy regardless of higher silver prices because their interest expenses consume any benefit. The sophisticated approach accumulates physical silver while selectively adding positions in financially strong mining companies. This combination captures both the direct price appreciation and the operating leverage that low-cost producers generate. The window to position for this remains open while markets still believe conventional rate-silver relationships hold. When that belief breaks, the repricing occurs rapidly. Here's the reality the Federal Reserve desperately hopes investors don't discover. Their inflation-fighting tools have become silver supply destruction mechanisms. Every rate hike pushes more mining operations toward shutdown. Every shutdown removes supply that cannot be quickly replaced. Every supply reduction pushes the equilibrium price higher. The Fed cannot admit this publicly. Acknowledging the silver problem would undermine their policy credibility. So they maintain their silence while the supply crisis builds. Investors who understand this dynamic will position ahead of the repricing event. Investors who trust outdated correlations will watch $200 silver from the sidelines. That's the breakdown of the Fed's silver problem and why rate policy now triggers price spikes rather than suppression. Drop a comment below. Are you positioned for this supply-driven repricing? Do you believe conventional rate relationships still apply? If this video revealed monetary policy dynamics that mainstream analysts miss, hit that like button. Subscribe and click the notification bell, because Fed policy shifts require immediate analysis. Stay informed, stay positioned, and never let outdated financial theory blind you to new market realities. See you in the next one.